very warm welcome to each and every one of you. I'm delighted that you can join us today for our annual Chrome Wealth Tax, Investment and Financial Planning update. So my name is Andrew Bradley, and on behalf of all the Chrome associates, I'm delighted to welcome you to the session today. I'm joined today by two colleagues who are assisting us in the presentation. But I think just a quick word on our title, our new permanent normal. I've borrowed that from Gareth Ackerman, the chairman of Pick n Pay, when he did his results announcement a few weeks back. He alluded to this new permanent normal that we as South Africans have to live in. And we've spoken before about is this a potential new normal? But what he is suggesting is that this is a new permanent normal. So we're going to cover a couple of interesting aspects of this. Firstly, from a tax point of view, we've had our budget a week or so ago. So delighted to have Dieter Schultz with us, the CEO and tax service line leader for RSM South Africa. They're a firm of accountants and auditors. And Dieter has joined us before and really appreciate his input in working with us and providing us with the tax update for today. He's going to be up next, followed by Nadine van Taak, who's given us the title of What's Happening in the World Right Now and How It's Impacting on Your Money. And I think that's certainly a topic we're all very interested in, knowing what's going on in this crazy world of ours right now and how that's impacting our money. And then once Nadine is done, I will then just finish off with a financial planning update. But Nadine works very closely with us within the Chrome Associate Group, assisting in the management of the Chrome funds, doing all the investment research and investment management in that space. So delighted that you could join us today as well, Nadine. Thanks for joining us again. It's now my pleasure to hand over to Dieter, who will do the tax update. Over to you, Dieter.
Great to be with you all. And Andrew, thanks for the intro. And yeah, as Andrew says, I've shared my insights in the past around the budget, and we'll be having a look at a tax update today. And maybe before we dive into some of the detail, it's just a case of kind of thinking back a week to the developments prior to the budget, anticipation around the budget, which is always an exciting time for me, and one of the highlights of the year, of course, because what that tells us is what tax amendments we're likely to see and what we can get into a debate with Treasury about as far as proposed amendments that are going to come through. And of course, the proposals are merely that, and the law then follows through the course of the year. We see bills coming out, we then see those open for public comment and their rounds of participation from the public. Finally, we see the promulgation of those proposals, normally kind of latter part of the year and early part of next year. So a long drawn out process, but the budget tells us the taste of what's to come. So let's then have a look and start with some of the statistics that were released as part of the budget. And it's always interesting to see what Treasury were projecting as far as revenue collections go last year this time, because of course that's where they released the budget for the following year. And we're then told at various stages during the year how they're doing in terms of those budgeted tax collections. And last year, they were budgeting about 1.6 trillion rand in tax collections. That was announced in the 2022 budget. And And we then have kind of seen a theme that has lasted a couple of years now, where those projections are in fact understated. So I think we've kind of seen a trend where Treasury have been quite conservative on the one hand, and on the other hand, we've had this anomalous kind of commodity boom where our mining companies have shot the lights out, and as a result have paid more corporate income tax, and we see them paying more dividends, which results in dividends tax. So Treasury hadn't anticipated that fully. And coming out of COVID, I think they were kind of so nervous about projecting too positively that we saw some pessimistic conservative budgets coming through. But at the medium-term budget last year in November, we saw that 1.6 moved up and increased by 83 billion rand. And then finally, in this budget, we're told that a further 11 billion improvement is projected to be achieved by the end of this month, end of March, because that's government's year end. So an overall improvement on budget versus actual of 94 billion rand. And I must say that that was a big relief for me, because I was quite anxious building up to this budget as to where this money was going to be found to deal with the likes of an Eskom, the other state-owned entities, our social grant system, etc., etc. And not to mention all the other areas where some serious fix is required in the country, all of which, of course, require funding. So that 94 billion was most welcomed. And what is also interesting on the bottom of this slide here is where that 94 billion overruns come from. So as I mentioned, corporate income tax, that's over by 75 billion. So by far the majority accounted for through corporate income tax. And as I said, our miners, and to a degree, some other sectors also overshot there. Personal income taxes, 14 billion over. That under by 13 billion. Fuel levies also under by 10 billion. But remember there we got the holiday on the fuel levy for a couple of months last year. And that was the result of that under recovery. Dividends tax, we saw a bit over. Customs duties, there was more activity on the import side, so a 14 billion overrun there, and other odds and sods making up the 94 billion rand that I must say I was very thankful for, and I think we can all be very thankful for. And that's why Treasury could keep our tax increases at a minimum, and we didn't see movements coming through by and large there. So the other factor that is attributable to this overrun is the efficiency of SARS. And I must say that's one thing that Edward Kieswetter has managed in his kind of short tenure at this stage as commissioner. He really has started turning that ship around, and we're seeing SARS being far more aggressive on the collections front. They're fixing their systems. You just look at the processes and the queries that are coming through. You can see that people are starting to look at this properly for the first time at SARS. And there really is a big drive and initiative going on there. So that's the start of things and kind of sets the tone. And then if we look at where that 1.692 trillion rand is coming from, it's always interesting to see who's paying the tax in the country. And you and I, personal income taxes make up by far the majority of collections. 35% come from personal income taxes. That, again, you and I, based on consumption, 25%. Corporate income taxes, only 20%, and that remains fairly consistent. Even with those super profits coming through in the mining sector, still 20-odd% of the total revenue collected. And then odds and sods, the fuel levies, customs duties, excise duties, dividends tax, transfer tax, property transfer tax, skills development, and other bits and pieces. So always interesting to see where our taxes are being collected and who's paying what. Moving on and looking at where the personal income tax rates have been or have moved, we see the personal tax brackets adjusted by about 5% for the 2024 year. So the structure of the tax tables doesn't change, the number of bands doesn't change. It's just that each of the bands have been stretched by 5%, and that's really to compensate for the effects of inflation. And our salaries kind of, if we're lucky enough, increase by an inflationary amount on an annual basis. And this 5% increase will go somewhere or some way to combat that inflationary adjustment. And where we then see our rebates is we've got 3 tiers of rebates depending on the taxpayer's age. The primary rebate moves by about 4.9%. And in fact, all these rebates have moved by about 4.9%. They've increased. Primary rebate, 16,425 to 17,235. Secondary rebate from 9,000 to 9,444. And the tertiary rebate, and those are for taxpayers age 75 and above, 2,997 to 3,145. So what that means, or what that translates into, are the tax thresholds. So those, by default, the tax thresholds for 2024 increased by 4.9%. And if you're aged below 65 years, that tax threshold will now be 95,750 Rand for the year. Age 65 and over, 148,217. Age 75 and over, 165,689 Rand. So before you start paying tax, that's the number that you need to be earning. The maximum marginal tax rate for individuals stays at 45%. So thank goodness no increase there. And also that kicks in at 1.817 million Rand in 2024. Our medical tax rebates, our Section 6 Cap A rebate, and those are for taxpayers that are contributing to a medical aid. Those increase by about 5%. And no increase in the capital gains tax inclusion rate of 40%. And again, our interest exemption thresholds stay the same, 23,800 and 34,500. And we were told some time back that those wouldn't change. Tax-free savings accounts were brought in instead. And we were told at the time, and this goes back a couple of years now, that these thresholds will not change in future and essentially will be eroded by inflation. So what is also quite interesting is this statistic, and it goes to personal individual taxpayers and the numbers of taxpayers that are on register at SARS. And if you have a look, there are about 14.6 million taxpayers on register. Of those, 7.5 million, half of those, don't pay tax. So they're earning below that 95,000 Rand limit, and they're paying no tax, although they're registered because their employers are obliged to register for them, register them for tax as part of the payroll process. And then if you look at the rest, and you look at the amount of tax that are collected via the rest, where you've got taxable income brackets, you've got numbers of registered taxpayers, you've got their taxable income, and the tax that is payable by those respective taxpayers. And really, by far, the majority of tax is collected in that kind of band between the 350,000 Rand and R1 million brackets, say. And if you look at the top earners, there are, let's have a look at taxable incomes in excess of 1.5 million Rand. There are 163,702 taxpayers, and those taxpayers contribute 193 billion Rand to the total collections on personal income taxes. So just an interesting stat there as to see the spread of taxpayers and where they sit from an income perspective and their relative contributions. So then moving on, and finally, I must say, I was so excited when I saw this because we've been squealing for an increase in the lump sum tables forever. And I think the last time we saw an increase come through was probably 10, 11 years ago. And those tables have now been stretched by 10%. So the threshold at which you can receive a retirement lump sum without paying tax has moved from 500,000 to 550,000. And so have all the other bands been stretched in that table. And then on the withdrawal table, and remember this table applies if you take an early withdrawal pre-retirement from your retirement fund, that table has also been stretched by 10% across the board. So great news there. We also see a stretch of 10% in the transfer duty rates. So each of the bands in the table stretched by 10%. So that's pretty welcomed. And this applies for properties that are transferred after or sold after 1 March 2023. So these new rates apply with effect from then and are in action for any property that is sold from now forward. Fuel levies, always interesting to see what's going to happen when you fill up at the tank. And thank goodness fuel levies have not been increased. The only increase that comes through there is on the carbon tax, and that's gone up by 1 cent per litre. So welcome relief coming through here. And how much do we pay to government every time we fill up our vehicle at the filling station? Well, if you're filling up with petrol, it's R6.17 per litre. And diesel R6.03 per litre goes to government. And then part and parcel of this budget was how to deal with Eskom. And some of the incentives we come through are initiated to try and relieve the grid and relieve Eskom of the demand that is coming through from the economy. And the first incentive that's come through is rooftop solar for individuals. And really this, as I've said, aims to increase electricity generation and relieve Eskom. So this has been done by way of a rebate as opposed to a deduction, which is an interesting concept and we see coming through more and more in our tax system. And really, this is something Treasury does not like. So I must say, this really is a crisis management situation and an emergency initiative. And what this rebate, or how you calculate the rebate, is 25% of the cost of the solar panels up to a max of 15,000 Rand. And what it does is it reduces our tax payable for the 2024 tax year. So if you're not paying tax, there's no benefit. If you are paying tax, that benefit is capped at 15,000 Rand. But the calculation of the rebate is based on 25% of the cost of the solar panels. So what are the catches, qualifying criteria? Only on our solar PV panels. And those must be purchased and installed on a private residence. At this stage, again, the devil's in the detail, but the idea here is that this applies to private residences. So will that expand to a private residence that's owned by a trust or a company, for example, but used as a private residence? That we don't know at this stage. We'll see the detail once the law comes out. Treasury has been quite clear that this applies per taxpayer, and as a result, two spouses, for example, partners living in the same house, can claim the incentive. So if each puts up panels or each pays for panels that are put up, each will qualify for the incentive. Importantly, the solar panels must be new or unused, and it does not include the cost of inverters or batteries. And you need a certificate of compliance, and that has to be issued between 1 March 2023 and 29 Feb 2024. So you can see here 1 year we've got to install these things. I must say, just looking at the surge in demand that's going on at the moment, I'm not sure that we're gonna see the supply keep up with the demand that comes through here. But certainly it's something, and it is going to create a frenzy as far as installation of solar goes. The next quite important change that's going to impact quite a lot of you, no doubt, is the proposal around trusts. And this relates to non-resident beneficiaries of South African trusts. Many of us have got families that are spread around the world, and beneficiaries of our trusts reside offshore. At the moment, if you make a distribution of a capital gain to a foreign beneficiary, the trust pays the capital gains tax at the trust's tax rate, effectively 36% flat on a capital gain. Double that of the individual in the case of a South African beneficiary. The proposal here is to mirror that with income. So at the moment, we can flow income through to non-resident beneficiaries, and that income retains its nature and is either taxed or not taxed, depending on the non-resident situation. We're going to see that blocked, and we're going to see the trust having to pay the tax at its 45% tax rate and the after-tax amount distributed to the beneficiary. Not great on that front, unfortunately, but let's have a look at the detail when these bills start coming out and commentary starts coming through. Just very quickly touching on some of the corporate proposals that have come through. The first one's not a proposal, it's in place. And just a reminder that the corporate income tax rate reduces from 28% to 27% for years of assessment on or after 1 April 2023. So our 31 March 2023 year ends are still taxed at 28%. 30 April and onwards are taxed at 27%, the 1% reduction. And remember, the set-off of assessed losses then kicks in. And those are limited to the greater of R1 million or 80% of taxable income. That's going to cause chaos. When it comes to provisional taxes into the 2024 year, there's going to be a lot of excitement going on there. But just be aware, because it's going to result in taxable income, even if there are assessed losses to carry forward, depending on the circumstance. So quite important, that one. We see the diesel fuel levy refund system extended to manufacturers of foodstuffs for a 2-year period. That's a welcome extension there. I see the retailers are squealing that they weren't included, but Treasury are adamant they can't extend it to the whole world. R&D allowances have been extended. And then I don't think I'm going to go through any of the rest, just given the time limitation that we've got, but just safe to say that there's been no increase in any of the other rates. So most welcome there. And I think the last slide that I need to deal with, and is quite important, relates to another incentive that comes through but relates to businesses on renewable energy tax incentive. And that's our 12 cap B allowance that's already in place. And really, what it does is it allows a write-off of assets that are installed in respect of renewable energy projects. And that extends beyond solar. It's also other renewables. But in essence, we're allowed a 3-year write-off at a 50%, 30%, 20% rate, other than for small PV projects, solar PV projects below 1 megawatt in size. So at the moment, that's what's in place. We now are going to see 12 cap B expanded, and a deduction will be given of 125% of the cost of all renewable energy projects. Now, that's massive. So that incentive is quite significant. There's no threshold on the electricity generation capacity. The asset has to be brought into use for the first time between 1 March 2023 and 28 Feb 2025. So critically important, a 2-year window here. So houses, we've got a 1-year window, and for businesses, we've got a 2-year window. Importantly, these assets must be used for trade purposes. So that entity must be conducting a trade, or that taxpayer. Doesn't have to be a company, can be an individual, can be a partnership, can be a trust, whatever the case is, but must be for purposes of a trade and used by that taxpayer to generate electricity. So critically important, the nuances there. So they're going to be quite specific, but I have no doubt there are going to be schemes that are coming out any day from now to try and flog this as a scheme. So watch the space, because I think the idea here will be that taxpayers, all and sundry, will be eligible for the deduction against their other income because they've invested in a partnership, for example, that qualifies for this deduction. And as a result, the losses will come out. So there we go. We've got some interesting incentives coming through, really to relieve Eskom of its burden and to shift the supply away from Eskom. So I think from my side, if that is about it. So Nadine, if I can hand over to you.
Thank you, Dieter. And great to be with you this afternoon. Thanks for inviting me, Andrew. I'm going to try and give you some insights into the world of investments over the last year. It was indeed a very, very rough year for investors. And then we'll turn to looking what's happening in markets, starting in South Africa and then going across to the States, and then a little bit of news on China. So if we look at last year, it was an extremely tough year for investors. What you see on the slide here is 2022 for the MSCI World, and every red dot represents the intra-year drawdown that you had on the MSCI World in dollar terms. So you can see last year, from the top to the trough, at a certain point in time, the market lost 26% of its value. And if you look at all the previous red dots, you can see that it's actually indeed one of the worst years if you look back till 1974 on this market. The market recovered a little bit, and you can see that we ended the market down at minus 18%. Not as bad as the 2008 minus 40 that we saw, but again, you can see that one of the worst years if you look back to 1974. And it wasn't only in global markets. If you do exactly the same on the local market, you'll see on the Aussie, in the intra drawdown was minus 13% on the market. We were very fortunate in South Africa to actually end the year positive. You'll see marginally positive. That was a plus 3.7%. I'll illustrate that a little bit later. But in terms of a drawdown number, again, one of the worst years we had going back to 1996 on our market. So it was, and obviously in between from a month to month basis, it was very volatile for investors. So that was looking at the long term. If you just look at 2022, you'll see what you see on the slide here is all the different asset classes from an investor point of view that you can invest your money in. So on the left-hand side in green is the local asset classes, bonds, equities, and property. On the right-hand side is offshore asset classes. But you can see the asset class that provided you with the best return just for the calendar year last year was actually, as we call it, the currency, but it's, let's say it's global cash, sitting close to 7%. So if you had all your money just in offshore cash, you would have returned close to 7%. Obviously, none of us invest like that because next year the picture will look very different. But what you can see from this, after offshore cash, the best performing asset class was actually South African asset classes, bonds and local equities. So if you were invested in offshore equities, in rand terms, you lost 12%. If you were invested in local equities, you actually gained 3.6%. So this is not always representative of asset classes over the long term. So last year was a complete outlier, specifically then looking at global cash. If you look over the longer term in asset classes, this is as until the end of Feb, you'll see that, yes, over 1 year, 2 years, shorter periods, some of the asset classes move around in terms of being the best performing asset class, like global cash, worst performing asset class, global property. If you move over to the longer term, so we're talking 5, 10, 15 years, you can see very clearly that equities, your risk assets, global equities, global property, local equities and property remain one of the best asset classes to get your returns over the long term. So what you've seen last year is volatility in the short term, but over the long term, you get the benefit from being in risk assets. And the good news on this is that we've been here before. This is a slide on the Aussie looking back to beginning of 2000. But you can very clearly see that along the way since then, there has been massive dips. If you just think back beginning of end of 2001, a 33% downward trend in markets. It took an investor 27 months to get back to that entry point. We had similar scenario in 2008 where you recovered only 30 months later. More recently, we had global pandemic. We had that China regulation scare. And then last year, the Ukraine invasion, Russia invading Ukraine. But unfortunately, this is the only way how you get to very decent returns above inflation. You have to go through the volatility. So last year was an extreme. It's absolutely normal for market cycles to go through this. If you want to protect your investments a little bit, typically what one would look at is to include more conservative asset classes like bonds. Now, last year, unfortunately, that also didn't help an investor. So this slide, what you see here, is looking at a 60-40 equities, 60 equities, 40 bond portfolio offshore. And every gray dot represent the risk. At the bottom, you'll see their standard deviation. So that's the risk of the portfolio. The risk at the bottom with your return on the left-hand side. So every gray dot represents 1 calendar year for a typical balanced portfolio. 60 equities, 40 bonds. But you can see where 2022 was. It was one of the worst years on record. The previous one was 2008. But you typically get, with a well-diversified portfolio, you get that correlation between asset classes, etc. Last year, it didn't work. So it was really a tough year for investors. What it also provided any investor with was opportunity. So deliberately, I didn't put the name of the company on the slide. But what you see here is a company, and I'm sure if I show you the name, it's a well-known company. You're all familiar with the company. But the share lost 57, in fact, more. It was close to 80% by year end of its value on the market on the back of the negative news flow. So remember, beginning of last year, we had the high inflation after COVID. Then we had the war, and there was a lot of negative news flow that was driving markets down. So this share was down 80% in value, let's call it that. On the right-hand side, we look at the fundamentals of this company. So the little block on the right-hand side here is the reflection of the debt on their balance sheet. But you can see this number is minus. It means they don't have any debt. They've got a net cash position, which means you've got absolutely, if inflation goes up or interest rates go up, you've got no additional interest payments, etc. So net cash position. On the top end, you can see their earnings per share, which is the way we illustrate how profitable a company is. So you can see going up all along. This was the forecast. This was the historic earnings per share for this company. And the red line is actually your return on invested capital. So illustrating, if you invest in this company, what is the kind of return that you get on your capital? So a 25% is actually extremely high. So if you look at this picture over here, and you look at a value which is close to 80% lower, you must say to yourself, this is a massive opportunity. It didn't happen across the board with all stocks, because all stocks deserve to be 70% down. But in many instances, there were examples of companies that's got very good balance sheets, and that was literally 70% cheaper than they were a year before. And that is an opportunity for any investor. So you all might wonder what this company is, but it's actually Meta. So part of the Meta group is the WhatsApp, Instagram, Facebook, etc. I'm sure you're all familiar with this company, but that is the kind of opportunities investors was also exposed to during the volatility of last year. If we turn back to South Africa, Dieter gave us the good news in terms of tax breaks for solar panels. I'm sure you all know of somebody that has installed or is going to install solar panels. Eskom is a big headache for us in South Africa for the economy. So I want to focus today on the impact on growth. So what you see on this slide, there's two lines. The red line is the world GDP. That is a world growth number that's gone up. And the blue line is South Africa, with the gray line, the one minus the other. So you can see at a certain point in time, 10 years ago, South Africa was growing faster than the rest of the world, and the gray bar was positive. But from then, it was actually a downward trend as we underperformed the rest of the world. So I think we sometimes forget, but our first period of load shedding was back in 2008, when we had first period of load shedding, stage 3 at that point in time. And then it sort of quieted down. Then there was a second period in November 2014 to Feb 2015, where again, we had load shedding more compared to the previous years. We're obviously in a very dire position at the moment, and this is impacting our growth. And if you invest, you want your money to grow. You can only grow your money if a company can grow. And if your country doesn't grow, it's hard to actually make money and make money for investors. So this is a big structural challenge for South Africa. And if you look at this slide, every bar represents the forecast that we had for a GDP number in the calendar year for South Africa. So this is the history. If you go back, this was COVID. We had a quick recovery after COVID, had a fantastic year, but then that was the forecast for the last 4 years. They've just recently actually downgraded the GDP, downgraded the GDP forecast for South Africa. It was 1.1 for 2023 this year. They've downweighted that to 0.3%. So that's what they expect the economy to grow at for the next year. The actual GDP number for the fourth quarter last year came out today. They were expecting a contraction of -0.4. It was actually -1.4%. So that's very negative for us in South Africa, because if you don't get the growth, companies is not going to make money in South Africa. The good news is there's a big difference between the market and what's actually happening in the economy. So if you just take the ALSI, the biggest stock in our local market, as represented by the ALSI, because just for reference, there's a lot of other indexes like the SWIX in the local market, but your biggest company with the biggest market cap is actually Richmond. So that stock has nothing to do with the South African economy. It's a basically a view on China selling luxury goods in China. So it's nothing to do with South Africa. The same with Anglos. They're exporting commodities, yes, but a lot of their revenue is actually generated from offshore. We've got Naspers, and you're all probably familiar with Naspers and Tencent process where they actually invested in Tencent, which is a tech stock in China. So if you look at the actual revenue that's generated from our market, you'll see that about 30% of the market is exposed to South Africa. The balance is the biggest to China, then the US, and the other is quite a big portion. There's a long list of countries in here. So when you invest in South Africa, you're unfortunately limited by Reg 28 to how much money you can take offshore if you're in that Reg 28 environment, but you can actually invest in the local market and not be exposed to the local economy. So that is good news from an investor point of view. If you look at like a FirstRand and a Standard Bank, those are the kind of stocks that's actually exposed to the local consumer. Last year, we saw as we mentioned, Russia invading Ukraine, which was a horrible event. Markets reacted very negatively towards that. There was the people side of things that was absolutely tragic. It's still going on. You still get, if you follow the war closely, it's 1 year anniversary was the other day. But from that, there was a positive, and one of it was the demand from commodities. So it is important to understand this because from our South African point of view, we export a lot of commodities. So at that point in time, this was one of the slides that was presented. It is the percentage of commodities that's produced by Russia. So for example, they produce 44% of the world's palladium. Platinum is quite interesting because we are exporter of platinum, and you see they between 10 and 15% of the world's demand is exported by Russia. So that had two benefits. The one was for South Africa, we are exporting commodities. So commodity prices went up and we benefited from that. And that was also a tailwind for the energy crisis in Europe to sort of change track and go more to renewables, exactly what like we see in South Africa, although the reason for our change is a little bit different towards that. So the commodity was a massive tailwind for South Africa, and I think this slide explains it very well. On the left-hand side, you see the manufacturing and mining production in South Africa going back to 2004. So you can see up and down, and then we had COVID, then obviously a rebase effect, and it came back to the long-term average. So that was within norm. But if you look on the right-hand side, the actual production is the red line at the bottom. So the volume, but the values went up massively. And this is very unfortunate for South Africa, because if we just manage to get the commodities to our harbors to export it to the world, we can actually get a lot more from this commodity demand that we see across the world at the moment. So although the values went up, the actual volumes we didn't benefit from. Luckily for us, the values that went up, we had a nice tax revenue from this, which the government spent very wisely last year, which meant a reduced debt level in South Africa. What it also meant is that was this massive support for our currency. So on the slide here, the red line is emerging market currencies relative to the dollar. So in this basket is a Brazil, a China, a Taiwan, a Mexico, all the emerging market countries. The blue line is our rand relative to the dollar. So we in the red line, but just to measure how have we done relative to peers. And you can see over the period here, that was beginning of last year when we saw that massive demand for commodities, our currency has strengthened relative to the peers. So you sat in a scenario where there's actually chaos in the world, but our rand strengthened. That was completely out of the norm, but that was on the back of the commodity story. Towards the end of last year, you can see we clearly underperformed emerging market currencies. But that was now again on the back of negative news, which was Eskom and the structural problems regarding growth that we've got in our country. So over time, we follow the emerging market currency basket quite nicely, but from time to time, things happen that is as we call it, an own goal, sometimes positive and sometimes negative. This is important to understand because you might say we're in a dire situation, negative GDP growth. Why is our interest rate still going up? So obviously interest rates is linked to inflation, but this is what happened last year with interest rates in South Africa. But one of the reasons we saw this happening, if the rest of the world is hiking, we cannot not hike. So even though you sit with extremely low growth and a high unemployment number, you need to protect the currency. We are in emerging markets. It's a very liquid currency. So to keep track of the world, we didn't have a choice. We had to hike interest rate despite the fact that we sit with low growth problems. If we move across to the US, why does it matter? The US is one of the biggest economies, the biggest economy in the world. This picture is only up until 2019, but you can see between the US and China, that is the growth engines of the world. The China numbers actually gone up since then. And we all expect that in a couple of years, China will actually overtake the States in terms of growth. So that is important to understand because that is driving growth in the world. But at the same time, they also sit with the reserve currency, the dollar. So they can basically do with whatever they want to do with interest rates, etc. If when there's trouble in the world, everybody is heading towards the dollar, all the other currencies depreciate because they've got that status of being the reserve currency. So it's very important to understand. And what we've seen happening in the US over the last couple of years is inflation. I'm sure you're aware of the inflation debate. If you go back to 2015, you'll see for a very long time, inflation was under control. It was coming in at 2%. I just want to zoom in on the last bit from 2020 COVID. You can see all of a sudden, we went from 2%, 4%, 6%. The high point last year was actually 8%. So now you sit with an economy that is typically 2%, and now they're going up to 8%. They obviously need to hike interest rates to get the inflation under control. Another matter that we need to take into account, because in the States, the Fed actually look at your core CPI number, not your headline CPI number. So headline is just all the components. I've listed them here for you. Every single component is contributing to the inflation number. You'll see this bracket over here. How much has that gone down 6 months later? So that was the new and used vehicles and then the energy. So remember a while ago, oil prices was extremely high and nobody could order new vehicles as a result of COVID because nobody could get, there was the supply and demand disruptions across the world. This component has gone down to a smaller component. But what is worrying is that the number over here is now consistent. I'll move on to the next slide. It's maybe a little bit more visual. The red line is the core CPI. They look at this number to hike interest rates or not, and that's your headline inflation number. So you can see clearly coming down from that point, but this number over here is worrying. And in here, for example, is labor and shelter. Those are probably the two biggest components that everybody is concerned about. So why does this matter? If they hike interest rates in the US, it has an impact on the whole world. It impacts the valuation of all asset classes because every single asset class in the world is priced off what we call the yield curve, and the yield curve priced off the interest rate. So for us to understand what is going to happen to investors' money, we need to have a view on inflation, then interest rates, and what's going to happen to the yield curve. So this is probably the biggest factor in investments across the world at the moment. And just to maybe illustrate to you how difficult it is for these people, not these people, the Fed, to decide what's going to happen with interest rates. On the right-hand side, you'll see they've got a committee. They've got a lot of people that vote. You'll see for 2023, they're all very close to each other. In other words, they all agree this will happen with interest rate. There's a little bit of a discrepancy, but close to each other. The minute you move out a year or 2 years, you can see the one committee member is saying interest rates will stay at 5.5%. The other one is saying it's going to go down to 2.5%. That's a huge range for interest rates. So the further out you go, the less predictable these things are. But this will drive markets. And if the market is pricing in this scenario, and the scenario completely the opposite happen, you'll have a reaction in the market. It will be short-term, but there will be a negative or positive reaction in the market. Why do they still hike interest rates? Inflation is high. But the second problem they've got is that growth is slowing down, and that's across the world. So you'll see after COVID, growth recovered, your light blue line recovered very nicely. And then all of a sudden that downward trend started happening. So it's across the world. It's not only in the US, we saw it in Euro happen, even in China, which we'll touch on now, is slowing growth. So only 14% of countries has now got a PMI above 50. So a PMI above 50 means your economy is expanding. If it's below 50, your economy is contracting. So very clearly across the world, we sit with inflation problems, higher interest rates, that's killing the economy. Why is that important to understand? Because this can cause a recession. If you hike too much, the consumer is dead and the economy goes into a recession. For us in the markets, a recession is already priced in. So what you see on the board here on the slide is a number of participants in a survey, and they've asked them, what do you think is the likelihood of the US going into a recession this year? And 65% of participants is actually saying it will go into a recession. But markets price this in. So that's the good news. The minute the economy is in the recession, the market is looking ahead to see what's going to happen after the recession. And this slide illustrates that very nicely. If you look at previous bear markets, you'll see this is the market, the dark blue line. The orange line is that PMI number that I was talking about. And the light blue line is the profit the companies are making, your earnings. But you can see the market will bottom and recover before the economy is in a recession, which is good news because the markets are looking ahead. So typically they price in a recession 7 months ahead. So we think, looking what happened last year, looking at all the negative news already, a lot of this has been priced in. Don't wait for the news flow to become positive, because by then markets is ahead and they're looking forward and they will be up. The last 2 slides from my side, just on China, we need to touch on China. Massive change last year. They had the zero COVID policy since COVID now. The rest of the world is almost operating normal. They were still going into a lockdown. That has changed in December last year. It's very important to understand that because the sentiment towards emerging markets is driven by China. China is the biggest region within the emerging market basket. And this heading zero COVID to 1 billion COVID, I think is very telling, because when they open up in a very short time, there's the time frame. A lot of things have changed in China, which is positive if you're a trading partner with China. This slide is illustrating in 1980 how few people were trading with China. It was basically China and some African countries. This is the picture in 2018. So if you're red, one of your biggest trading partners is China. And if you're blue, your biggest trading partner is the US. So very clearly, China is infiltrating the rest of the world. And it's not as easy for the US to say, we're going to shut you off like they've done with Russia. China is part of the world economy. They're trading partners with everybody. And this is positive because if they reopen and there's pent-up demand and people starting to spend money in China, the rest of the world will benefit. Richmond is going to sell more Louis Vuitton handbags in China when they open now. So there's a lot of positive stories around this. There are negatives, and I think we can't ignore that. Their property sector is looking dire. They keep on, or there's speculation that they're going to invade Taiwan. I think that is much more of a reality given what happened with Ukraine and Russia last year. There's Xi Jinping that is again in power. So that's all the negative sentiment. I've mentioned some of the positive. I'm not going to go into that now. But the one point that I just want to highlight as my last slide, China, yes, previously, a couple of years ago, they were growing at 10%, 11%. They're now forecasting to grow at 5%. So 5 is less than 10%. We acknowledge that, but 5% is more than the 0.3 that we see happening in South Africa, or the 1.3 that they forecast for the US. So there's growth opportunities, and you need to just marry the growth opportunity with some of the negative sentiment on a regional level. With that, I'm going to hand back to Andrew.
Thank you very much, Nadine. Much appreciated. I'm going to sort of jump in now to the financial planning component of the update. As one can see, some of the topics that have come through in both Dita and Nadine's updates are the issue of load shedding. I'm going to touch on it from a different perspective, grey listing, and then some retirement planning. So firstly, from load shedding, I think we all know the effects of load shedding on our daily lives. I think this is having personal, health, and financial planning implications. And the key thing is, well, what are we as individuals going to do about it? And you can sit back and do nothing, and I don't think anyone can or is planning to do that. So we've got to find what we're trying to solve for and decide on what your aims are. Now, this has some significant financial planning implications, and it's important that you're very clear. I saw a cartoon the other day by this old sort of fat gentleman who they said was, in his late 60s, and this young, beautiful woman giving him a kiss. And they said, well, that's a form in this world, and this is a solar installator. And so implying that, that's the sector of the economy at the moment that is doing exceptionally well. And I think Dita even alluded to some of the schemes going on there. So, anyone who's trying to make a quick buck is getting into that space. And it's important that, we understand the consequences of any decision that we take in that regard. So I think these are hopefully some guidelines that can assist us. We worked through this with some of our colleagues. And so I think the first one is, be clear about what you're solving for. Is it to avoid the negative impacts of load shedding so that, you don't fall in the dark? Or is it to ensure a baseline of some normal day-to-day living? So you maybe watch some TV or listen to the radio or, whatever else you want to do. Or is it working from home? That is a completely different requirement and functionality that you would need to set up. Or are you trying to go off the grid? And by that, I mean, become as self-sufficient as you can. Another thing to think about, whatever you're going to do, is it going to be removable or is it going to be linked to your property? Because there's a whole lot of talk now that if you put this infrastructure into your property, it increases the value of your home. Some people are saying that it actually doesn't increase the value of your home at all. And so I think it's too early to say exactly what the outcome of that is. But I think you need to be clear. It is possible to put in equipment to the extent that if you move home or you're in rented property, you can actually take it out with you. So be clear about those. Those are some ideas that we've thought through of what you need to do, because whatever one of those options you choose will have implications and consequences for what you do. And then you need to look at what constraints you have. Now, obviously, all of us have a budget, and certainly whatever your budget is will have a certain capacity of load. So if you can only afford a certain amount of money, then you can only have a certain level of battery, potentially solar, inverter, etc. The other thing to think about is not only what the cost is now, but also in future, because many of these products have a 5, 10, or 15-year lifespan, and then one needs to upgrade into that. So consider and make sure that you have built this into your financial planning, not only now, but in the future. The other is physical constraints you have. If you live in an apartment, it might be very difficult, if not impossible, to put solar panels on the roof. If you're in a complex, there may be restrictions around that. So be very aware of what those are before you go down the road with any of this. And then it's also important to reflect that when you try and take care of load shedding, is that there are many different components to the solutions. And when you put this in, ensure you understand what the capacity is of the equipment, the size of the equipment, the lifespan, and the warranty period. And those are two very different components to that. So the one which in every instance you will need is an inverter. So some people are putting in a simple inverter that just takes out of the grid when there's electricity to enable you to have the power when load shedding is on. But then it's a completely different machine an inverter which does that, but can also take from solar. So, if you're going to potentially put in solar now or later, make sure that you have a hybrid inverter that can do both. So don't spend money unwisely in that regard. Battery, again, batteries are a huge expense, and understand the capacity of that, which batteries you get. And everyone's saying, obviously, now lithium batteries are the way to go. And if you might get batteries now a lot cheaper, but if they're not the right ones that are going to go dead very quickly and won't have a good lifespan, make sure you're getting the right batteries. But then also when you do this, there's also a whole lot of accessories that you need to put in. So that's connection with your distribution board, or your electricity boxes, fuses, switchovers, etc. So all of those things come with additional costs. So when you're getting your quotes and looking at this, make sure you understand all the componentry that comes in. And then potentially, if you're going to put solar panels on your roof, that will obviously not just suck the electricity from the grid, but provide you with electricity during load shedding and other periods. I came across someone who was doing a quote for me who made the suggestion of saying, our geysers are a big drawer of electricity. So if you have solar panels for that, but what happens if there's some, couple of days of rain, clouds, and the solar panels aren't working? How about putting the gas water heater in? So, many of us who went to the bush or on farms in the old days, that those gas burners that heats the water instantly. Technology has moved on rather remarkably, and I've got them to quote for me of putting a gas heater or just the geyser component of that. So that will ensure that when the solar is not there, I never have to use Eskom electricity for my water. And it may work for some people. It's certainly something that I'm looking to implement. So you've got all these components here, and needless to say, these are all pieces of equipment which we would have hoped and wished we didn't have to know about and didn't have to become familiar with. But the more we know about them, the better equipped we are, the more informed decisions we can make, and the better our quality of life will be. Also, just bear in mind some practicalities of installation. Your inverter and battery requires a short distance to your distribution board. The longer it is, the more costly it is. It needs to be in a cool space, away from the sunlight, heat, moisture, and ideally people. So think about that. Inverters with fans can be very noisy, both during load shedding and sort of recharging. So think about that. You don't want now to have a whole lot of unnecessary noise. And then the grid circuits that are powered by inverter during load shedding, are they done during load shedding or not? And so, aim to get certain plug points on mains only. So, it might be like in my instance, a pool pump. I'm saying, okay, well, that will never be used from the battery. That, if there's load shedding on, then just, the pool pump won't work. So there's certain plugs like that that you might say will never be on the battery, and use the power for that. And then if you're going to make sure that you have automatic switchovers, you need to do that very strategically. So what comes on, what doesn't. And then probably the most important thing, Dieter did allude to this, that you need a certificate of compliance for installation, and it needs to be in this next year, but just ensure you get one, because there are a whole lot of other implications for that should you want to sell electricity back to the grid at some point in the future as well. So a whole lot of new things that we need to think about, not something as we would want to do, but important to do. Because I think, as I said, this does and will have an ongoing impact on our quality of life, and certainly what it appears like for certainly the next 10 years plus, if not on a permanent basis. This is something that we're going to need to apply our minds to and be dealing with. So then the second issue I want to cover is grey listing. So there's the Financial Action Task Force has grey listed South Africa. FATF is effectively the global anti-money laundering watchdog. So they see countries around the world to prevent money laundering and funding terrorist activities. And they've been, putting various countries on the grey list for a while. And so we joined a fairly illustrious list there now. And I think one of the key things that they identified in that is that although we do have some, good processes in part, we've gone through this state capture, and with that, a whole lot of people were identified, and not one prosecution has happened in that regard. No accountability for money laundering and unlawful activity. So, I think they've put a lot of pressure on government now to put in place not only legislation and the regulations around this, but ensure that they take action as and where that is required. And I think, that's obviously good news for all of us. And it's critical that they do that, and hopefully government does. Having this in place isn't great for us as a country or for us as individuals. And it might not be totally obvious to some of us that this has happened, but there certainly are going to be a lot of implications. The first one, Nadine has already alluded to the fact that because of load shedding, the South African economy has not grown as much as it can, and certainly this will increase further the cost of doing business in South Africa. So if you're a company overseas that wants to come into South Africa, it's going to increase the cost. Just for us doing business with each other in South Africa, it is now going to increase the cost of us doing business, let alone sending funds offshore and dealing with international banks will become very difficult. We're already seeing many of our clients who potentially have bank accounts overseas, those international banks now wanting to close those accounts because of our South African link. So we'll find from a governance point of view, a compliance point of view. I was dealing with one of our clients in Mauritius last week, and even the Mauritian banks now are becoming a lot more sticky, a lot more onerous requirements on us to prove who we are, what we are, where the money comes from, and that the money's clean money and not from any money laundering or any other nefarious activity. And then sadly, this is likely to reduce foreign investment in South Africa, which we desperately need. So not great for us as a country, not great for us as individuals, but something which hopefully the government will take seriously, and they've undertaken that they will, but we need to keep putting pressure on them to ensure that they do so, because it is possible to go through the list. In fact, I alluded to Mauritius. Mauritius as a country went onto the grey list about 3 years ago, and they had an action plan, and within 2 years they got off the grey list. So it is possible to do, and we hope that the government certainly does so. And then just from a retirement planning point of view, Dieter did mention it, the inflation adjustments of the additional 50,000 in retirement fund lump sum that is available. So in essence, now, even if you've taken your 500,000 already, if you have a retirement fund, you can now access that additional 50,000. So from a retirement planning point of view, it does create some additional opportunities, also with the addition of those inflation-adjusted increases in the amount above the tax-free amount. So it does open up some additional tax planning opportunities there, as well as looking at the other component that isn't taken out as a lump sum into living annuities, which, as we know, things haven't changed. They're not estate dutiable, and is probably right now the most efficient and effective way of passing assets on from one generation to another. And then the other aspect, which is the early access to retirement funds, the so-called two-pot system that they referred to. So, in a normal retirement fund, you're allowed to, at retirement, access 1/3 as a lump sum, and the other 2/3 goes to buy your pension. So what, during COVID, there was a thought that, people are struggling financially, let's give them access to their retirement funds. And so this process has carried on now for about 3 years. They have said that they will introduce this in March next year, 1st of March. At this point, they haven't provided with the final piece of legislation, which they said they will do by September. The last draft that I saw, makes it very, very prohibitive to even contemplate this. So the first thing that they've said is, so let's assume you already have 300,000 in your retirement fund. You'll say, oh, well, I'll be able to access 100,000 now when this comes into being early. Firstly, they're saying it's only for funds that is the 1/3 after 1 March. So now from an administrative point of view, it's going to create a lot of challenges there because you're going to be able to access that pot. It's only money that goes in there after 1 March next year. And then the second aspect is from a tax point of view, it's going to be very, very onerous from a tax point of view. Whatever you take out is going to be taxed as a retirement fund withdrawal, which, as again, Dieter showed, that only the first 25,000 is tax free, and beyond that, taxed at a very onerous rate. So we don't know if it's going to be exactly like that, but it will also have further negative implications when you do get to retirement and want to access your 500,000. So really it's a bit vague at the moment, but one thing that is very, very clear, unless things change dramatically, it is an option if you have absolutely no other alternative. And it is very, very negative for any individual who wants to access it. So while a possible step forward, in fact, in my opinion, by and large, a very damp squib in that regard. That's all from my side. What I'd like to now do is just open it up to questions. If anyone has any questions for myself and Dean or Dieter, please do let us know. You can go into the chat and questions and answers, and we'll try and answer that. But firstly, from my side, just thank you to everyone for joining us today. Thank you very much to Dieter and Dean for your inputs and contribution. As always, most informative and enlightening. Let's see, are there any questions? At this point, we don't seem to have any questions, and often I reflect when there are no questions, the presentation must be very good or very bad. So let's assume that it was very good. Okay, top 3 opportunities. I'll assume that isn't from a tax exploitation point of view, Dieter, but maybe the Dean, you can just say from an investment point of view what your views are right now.
Sure, that's a difficult one. I think the one thing that I can say, I think if you've got a time horizon of 10 years out, I don't think it's a bad opportunity to invest now. You might have a better opportunity in 3 months or 6 months time, but we can never time the market. So I think if you look back in 10 years from now and you haven't invested cash that you wanted to invest, you're going to regret it. But the top 3 is very difficult to say.
So that you're still positive about equity exposure, yes. South Africa or globally?
Definitely globally. I think global is definitely orientated towards growth, where the South African market is more valuation orientated at the moment. Look, we are forced to invest anyway in South Africa, but we're not optimistic about SA Inc. stocks, which we call the South African incorporated stocks. They purely rely on the SA economy to do well. Those will be under pressure, but there's different ways to invest. So as an asset class, we still like equities, but I would say, yes, we prefer global equities.
Okay, then there's a question, would we still recommend exporting as much cash as possible? And if so, which jurisdiction? So, I mean, my response to that is that if one's, ultimately going to be living in South Africa, it's make sure that you've got the cash flow to take care of it, because once you've moved money overseas, not impossible to bring it back, obviously is, but there's costs, there's timing issues, and a risk in doing so. But in taking it out, I would still recommend that one has a very healthy amount of money offshore. So if you've got any surplus cash, most definitely take it offshore. In terms of a jurisdiction point of view, I think right now there's a whole lot of risks, and Nadine coming here in the US, and less risks in Europe. So there are two aspects. So from a currency point of view, I think the US dollar is maybe a bit at risk this year. But as Nadine says, it's the sort of the base currency in the world. But then actual companies. So there's two things. One's the currency, one's the company. I think there's some very good investment opportunities in Europe right now. Nadine, anything more specific?
No, I would agree with that. The one thing that I didn't add a slide on is valuations of markets, but exactly what you said now, Andrew. So the US came off last year, compared to Europe, it's still expensive. And eventually you want to buy a good company at a good price. And Europe is definitely offering the opportunities. But as always, it's good to be diversified across different jurisdictions and different opportunities.
And the UK?
UK is also, look, it's cheap. Might be cheap for a reason. But yeah, it's definitely from a valuation point of view, more attractive than the US. Yeah, you just need to make sure you know what the drivers of the underlying companies, and that they will be able to withstand a lot of the challenge they also see there.
Yeah, there's certainly, you know, the news flow from the UK is very challenging news flow. There's a lot going on there. And
unfortunately, market do react on news flow more than fundamentals, in the shorter term at least.
Okay. Thanks very much. There don't seem to be any further questions. So my final thank you to you, Nadine. Thank you to you, Dieter. And thank you to you, Selma, for assisting us, and Analytics for giving us the facility to do this. Thanks, everyone. Enjoy the rest of your day. Cheerio.
Bye.
Bye.